The IFRS Accounting Taxonomy 2024 Update 1 marks a significant development in the evolution of digital financial reporting, aligning with the issuance of IFRS 18, Presentation and Disclosure in Financial Statements. This update not only modernizes the structure and labeling of tagged financial information but also supports improved presentation, consistency, and comparability in financial reports, especially when disseminated through electronic means such as XBRL, Extensible Business Reporting Language. IFRS 18, Enhancing Financial Reporting and Presentation. IFRS 18 introduces a comprehensive framework to redefine how companies present and disclose financial information in their primary financial statements. It replaces key sections of IAS 1 Presentation of Financial Statements, while retaining many of its core principles. The aim is to enhance transparency and comparability across entities by requiring more structured disaggregation of information in the income statement and other financial statements, introducing a standardized structure for the statement of profit or loss, including defined categories, operating, investing, and financing, improving the clarity and usefulness of management-defined performance measures, MPMs, requiring entities to explain subtotals and disclose reconciliations to IFRS-defined measures. These changes are intended to ensure users can more easily analyze and compare the performance and financial position of companies, regardless of industry or jurisdiction. The role of the IFRS taxonomy in digital reporting. The IFRS Accounting Taxonomy is a structured classification system that enables the consistent tagging of financial data in digital reports. With the release of IFRS 18, Update 1 to the 2024 taxonomy integrates new elements for IFRS 18 line items, subtotals, and disclosures, tags for management performance measures and the required reconciliations, revised labels, hierarchies, and references to reflect the new standards terminology and presentation requirements. This taxonomy update ensures that entities preparing IFRS-compliant digital financial statements can accurately tag their information in a way that reflects the new presentation and disclosure structure introduced by IFRS 18. Transition from IAS 1 to IFRS 18. While IAS 1 laid the foundational principles for financial statement presentation, its limitations, particularly in the consistency and transparency of profit or loss presentation, prompted the need for reform. IFRS 18 addresses these shortcomings by making disaggregation principles more specific and enforceable, introducing prescribed profit or loss categories to reduce entity-specific variation, formalizing requirements around non-IFRS performance measures. Although IFRS 18 replaces parts of IAS 1, the broader principles of fair presentation and faithful representation remain intact, now reinforced through improved structure and disclosure detail. The introduction of IFRS 18, Presentation and Disclosure in Financial Statements represents a significant shift in how financial information is structured and communicated. Replacing key aspects of IAS 1, IFRS 18 brings a more standardized and transparent approach to presenting financial performance, particularly in the statement of profit or loss. This shift emphasizes clarity, comparability, and consistency across entities by introducing defined categories, operating, investing, and financing, and by requiring more detailed disaggregation of information. It also introduces specific guidance on management-defined performance measures, ensuring users can distinguish between IFRS-compliant and entity-specific metrics. Aligned with this change, the IFRS Accounting Taxonomy 2024 Update 1 enables accurate digital tagging of financial data under the new presentation structure. This supports a more effective and globally consistent dissemination of financial information in XBRL format, allowing stakeholders to better analyze and compare entities. In essence, this shift reflects a broader movement toward enhanced transparency and digital readiness in corporate reporting, responding to the evolving needs of investors and regulators in a data-driven global economy.
The issuance of IFRS 18, Presentation and Disclosure in Financial Statements reflects the IASB's strategic response to long-standing concerns about how companies present financial performance. While IAS 1 provided foundational guidance for financial statement presentation, it lacked the precision and consistency required in today's complex financial landscape. IFRS 18 was developed to address these gaps, with four major imperatives driving the need for change. 1. Addressing inconsistencies in presentation. One of the key problems under IAS 1 was the wide variation in how entities presented income and expenses, especially within the statement of profit or loss. Entities had significant discretion in choosing line items and subtotals, often leading to confusion or ambiguity about what was included in key performance metrics like operating profit. IFRS 18 introduces a defined structure, including mandatory categories, operating, investing, and financing, to reduce this inconsistency. This ensures that companies use common definitions and formats, making financial statements easier to understand and compare. 2. Meeting investor demand for transparency. Investors have increasingly called for more transparent and comparable information about how companies generate profits and manage resources. They want clarity on performance metrics, especially those created by management, and visibility into how these relate to IFRS-defined measures. IFRS 18 responds to this by requiring disclosures of management-defined performance measures, MPMs, along with reconciliations to IFRS measures. This enhances transparency by showing how management's view of performance aligns, or diverges, from standard accounting presentations. 3. Improving comparability across entities. Comparability has long been a concern, particularly across companies operating in the same industry. The lack of defined profit or loss categories under IAS 1 allowed similar items to be reported differently by different entities. By introducing a standardized profit or loss structure, IFRS 18 ensures that like items are grouped together, enabling analysts and investors to make meaningful comparisons across entities and sectors. This is particularly important for global capital markets, where cross-border investment decisions depend heavily on consistent reporting. 4. Enabling structured disaggregation of information. Modern users of financial statements demand greater detail, not just totals, but insights into what drives them. IAS 1 allowed excessive aggregation, obscuring important distinctions in income and expense classifications. IFRS 18 tackles this by requiring structured disaggregation, supported by clearer principles and illustrative examples. Companies must now break down large, mixed items into meaningful components where relevant, improving the granularity and usefulness of disclosures. IFRS 18, Presentation and Disclosure in Financial Statements introduces a reimagined structure for financial reporting, designed to enhance clarity, consistency, and comparability across entities and industries. Replacing key sections of IAS 1, this new standard responds to long-standing concerns about the lack of consistency and transparency in how companies report their financial performance. At its core, IFRS 18 is built around four fundamental principles that aim to modernize financial presentation: mandated categories in profit or loss, defined management performance measures, MPMs, enhanced disaggregation, and reduction in diversity in practice. 1. Mandated profit or loss categories. Under IAS 1, companies had significant discretion in how they organized and labeled items in the statement of profit or loss, leading to inconsistent and often incomparable formats. IFRS 18 addresses this by introducing a standardized structure, requiring entities to classify income and expenses into three clearly defined categories. Operating, the default category, generally including items from the entity's main business activities. Investing, income and expenses from investments that generate returns independently of operations, e.g., dividends, gains on equity investments. Financing, costs associated with obtaining finance, e.g., interest expenses. This structured layout enables stakeholders to understand where performance is coming from and compare financial results more effectively across different entities. 2. Defined Management Performance Measures, MPMs. Many companies report non-GAAP or custom performance metrics, like adjusted EBITDA, in their communications with investors. While these measures can be useful, they often lack consistency and transparency. IFRS 18 introduces formal requirements for disclosing management-defined performance measures (MPMs) when they are publicly used outside the financial statements. Under the new framework, MPMs must be clearly defined and explained. Reconciliations to the most directly comparable IFRS subtotal must be provided. Entities must justify the relevance of the measure. This enhances the credibility and comparability of alternative performance metrics, giving investors insight into how management views financial performance without allowing unchecked flexibility. 3. Enhanced disaggregation. One of the major criticisms of financial reporting under IAS 1 was the over-aggregation of financial line items, which obscured critical information about a company's operations and risks. IFRS 18 directly addresses this by requiring more detailed disaggregation of financial information based on nature and function of expenses, characteristics of items, e.g., volatility, persistence, relevance to users' decision-making. This principle ensures that users receive clearer, more granular information, making it easier to analyze drivers of performance, identify risks, and evaluate management decisions. 4. Reduce diversity in practice. A key goal of IFRS 18 is to minimize the diversity in reporting practices that has made comparison across entities difficult. The combination of mandated P&L categories, uniform treatment of MPMs, specific disaggregation guidance, standardized subtotals, e.g., operating profit, means that entities are now working from a consistent reporting framework, even while retaining flexibility to present entity-specific information where appropriate. This reduces ambiguity and strengthens the faithful representation of financial performance. IFRS 18 introduces significant reforms that redefine how financial performance is presented and understood. At the heart of the changes are mandated categories in the profit or loss statement: operating, investing, and financing, which promote consistency in reporting. The standard also formalizes management performance measures, MPMs, requiring clear definitions and reconciliations to IFRS totals, thus enhancing transparency around non-GAAP metrics. Additionally, IFRS 18 pushes for enhanced disaggregation of income and expenses to provide users with more detailed and decision-useful information. Collectively, these changes reduce diversity in practice and foster greater comparability and clarity across financial statements.
IFRS 18 introduces a structured and standardized layout for the statement of profit or loss, aiming to improve clarity and comparability across entities. It mandates the classification of income and expenses into clearly defined categories. Operating activities reflect the entity's main revenue-generating activities and serve as the default classification. Investing activities include income and expenses from investments that generate returns independently of operations, such as dividends or fair value changes on equity investments. Financing activities cover expenses related to obtaining finance, such as interest expense on borrowings. In addition to these, IFRS 18 introduces two new categories: the Integral Associates and Joint Ventures category, which separately presents the share of profit or loss from investments that are closely related to the entity's operations. The Equity Accounted Associates and Joint Ventures category for non-integral entities, ensuring clearer distinction in performance analysis. IFRS 18 also requires mandatory subtotals, such as operating profit, which provides a consistent anchor for comparing core business performance across companies. This structured categorization enhances transparency, reduces presentation inconsistencies, and supports better investor decision-making. Under IFRS 18, management performance measures, MPMs, are brought into the spotlight with a clear mandate for transparency and accountability. These are subtotals of income and expenses that management uses publicly to communicate performance, but are not defined by IFRS. To reduce ambiguity and increase comparability, IFRS 18 introduces a defined scope for MPMs and requires that they be presented only in the notes, not on the face of the financial statements. Preparers must now provide specific disclosures for each MPM, including a clear definition and label of the measure, a reconciliation to the most directly comparable IFRS subtotal, e.g., operating profit or net income, a description of how the measure is calculated, and an explanation of why the measure is relevant to users. This new framework ensures that while entities retain the flexibility to communicate performance from their own perspective, such communication is now standardized, traceable, and easier to understand, ultimately strengthening investor confidence and decision-making. One of the key innovations in IFRS 18 is the requirement for enhanced disaggregation, aimed at providing users with more granular, decision-useful information. Previously, under IAS 1, entities had significant discretion in aggregating line items, often leading to high-level summaries that masked important differences in the nature and function of income and expenses. IFRS 18 addresses this by requiring disaggregation based on different characteristics, such as the type, function, measurement basis, or variability of items, ensuring that distinct economic features are clearly presented. The standard also places greater emphasis on providing detailed breakdowns in the notes, where more complex or material items require further explanation. This increased granularity enhances the analytical usefulness of financial statements by giving stakeholders better visibility into key components of performance, such as cost drivers, revenue streams, and unusual or non-recurring items. Ultimately, enhanced disaggregation reduces information gaps between management and investors, enabling users to more accurately assess risk, performance, and trends. It supports clearer storytelling within financial reports, leading to more informed and confident decision-making. The IFRS accounting taxonomy plays a critical role in enabling high-quality digital financial reporting, particularly as standards like IFRS 18 reshape how information is presented and disclosed. The taxonomy provides a structured system of tax, compatible with XBRL, extensible business reporting language, that allows financial data to be reported in a machine-readable format. This improves accessibility, comparability, and analytical efficiency for investors, regulators, and analysts. With the introduction of IFRS 18, the 2024 Taxonomy Update 1 incorporates new elements for structured profit or loss categories, management performance measures, and enhanced disaggregation. This alignment ensures that digital reports accurately reflect the substance and structure of financial statements under the revised standard. By supporting real-time data analysis and automated review, the taxonomy reinforces the goals of IFRS 18, greater transparency, consistency, and usability, making it a cornerstone of modern, tech-enabled financial communication.
The IFRS Accounting Taxonomy 2024 Update 1 integrates the structural and disclosure reforms introduced by IFRS 18, ensuring that digital financial reporting remains consistent with the new standard. This update incorporates key elements such as the new profit or loss categories, operating, investing, financing, and income/expenses from integral associates and joint ventures, enabling clear, standardized tagging of financial data. In addition, the update introduces tags for management performance measures, MPMs, and the required reconciliations to IFRS-defined subtotals. These elements ensure that entity-specific performance metrics are transparently and accurately reported in digital formats. The taxonomy also includes new tags for integral income and expenses, enhancing the clarity and comparability of entity-specific disclosures. By embedding these changes, the 2024 Taxonomy Update facilitates consistent, structured, and machine-readable reporting, aligning with the broader objectives of IFRS 18 to improve transparency, comparability, and stakeholder confidence in digital financial communications. The adoption of IFRS 18 and its integration into the IFRS Accounting Taxonomy 2024 Update 1 has important implications for digital reporting, especially in an environment increasingly reliant on XBRL, extensible business reporting language. With the introduction of new taxonomy elements for profit or loss categories, management performance measures, MPMs, and detailed reconciliations, entities can now tag their financial data more precisely and consistently. This structured tagging enhances data comparability across companies and industries, enabling investors, regulators, and analysts to conduct more efficient and accurate comparisons. It also reduces manual efforts in extracting and interpreting financial data, allowing for faster dissemination and integration into automated systems. Furthermore, the improved granularity and consistency in tagging support enhanced oversight and real-time analytics, empowering stakeholders to detect trends, anomalies, and risks with greater confidence. As digital reporting evolves, the taxonomy lays the foundation for a future where financial communication is smarter, faster, and more transparent. The implementation of IFRS 18 and its integration into the 2024 IFRS taxonomy marks a significant shift toward more transparent, consistent, and digitally enabled financial reporting. Entities will face initial challenges in adapting systems and processes, but the long-term benefits include enhanced comparability, improved investor trust, and streamlined digital disclosure. Looking ahead, this reform sets the stage for continued alignment between accounting standards and evolving stakeholder expectations in a data-driven world. The adoption of IFRS 18 brings transformative changes that significantly affect both preparers and users of financial statements. For preparers, the standard introduces a more structured and demanding reporting framework, requiring changes in how financial data is classified, disaggregated, and explained. Companies must adapt their systems to apply new profit or loss categories, provide reconciliations for management performance measures, MPMs, and ensure consistent, entity-specific disclosures. This may involve enhanced internal controls, data collection processes, and collaboration across finance, sustainability, and strategy teams. For users, such as investors, analysts, and regulators, IFRS 18 delivers greater transparency, comparability, and insight. Standardized subtotals and clear categorization of income and expenses make it easier to understand a company's core performance. The formalization of MPMs, alongside required explanations and reconciliations, gives users a clearer view of how management interprets performance while maintaining a strong link to IFRS-defined measures. Overall, the impact is twofold. Preparers are challenged to improve the quality and coherence of reporting, while users benefit from more reliable, insightful, and consistent financial information to support better decision-making.
The release of IFRS 18 represents a significant shift in financial reporting, aimed at aligning accounting practices with the evolving demands of global stakeholders. As companies move toward adoption, the standard signals a step forward in creating sharper, more meaningful financial statements, grounded in clarity, structure, and technological readiness. At its core, IFRS 18 promotes consistency, transparency, and comparability. By mandating structured categories in the statement of profit or loss, enhancing disaggregation, and standardizing the disclosure of management performance measures, MPMs, the new framework reduces reporting variation and improves the quality of insights available to users. Crucially, the accompanying updates to the IFRS accounting taxonomy ensure that these improvements extend into the digital realm. With enhanced XBRL tagging and digital compliance tools, entities can produce machine-readable, investor-ready reports that align with the expectations of regulators and analysts alike. As the standard takes full effect in 2027, preparers have a clear roadmap for transformation. Now is the time to build capacity, review systems, and develop cross-functional processes to ensure compliance and competitiveness in an increasingly transparent and tech-driven reporting environment. The future of financial reporting is moving toward a model that is more transparent, consistent, and digitally integrated. With standards like IFRS 18 and advancements in the IFRS accounting taxonomy, financial reports are becoming clearer, more comparable across entities, and easier to analyze through technology. We can expect greater emphasis on non-financial information, such as sustainability and intangibles, presented alongside traditional financial data in a more connected and holistic narrative. As digital tools like XBRL become standard, reporting will shift from static documents to interactive, real-time data platforms, empowering users with deeper insights and better decision-making.